Here's what price actually looks like. Every tick a little battle between buyers and sellers. Can you tell if this stock is trending up, down, or sideways? Probably not. The noise hides the signal. Now draw a line through the middle of it. That's a moving average, and suddenly you're not trading noise, you're trading direction. In this video, what moving averages are, which three matter most, and the one ArcAlpha uses as your mean. So what exactly is a moving average? It's the average closing price over the last n bars, and it moves forward as each new bar closes. Let's build one. Take the last 5 closing prices. Add them up, divide by 5, that's 1 point on the line. A new bar closes, drop the oldest, add the newest, recalculate, that's your next point. Do this every day and you get a line, the moving average. A short period average 5, 10, 20 bars hugs price tightly. It reacts fast but picks up more noise. A long period average 50, 200 smooths harder but reacts slower. That's the trade-off every moving average forces you to make: responsiveness versus stability. Moving averages don't predict. They describe, summarizing where price has been so you can see where it's going. One number per bar, a line that follows price. That's the foundation. The simplest version is the SMA, simple moving average. Every bar in the window counts the same. That sounds fair, but there's a problem. A big move 20 days ago gets the same weight as yesterday's close. When price reverses, the SMA drags old data with it, slow to reflect what's happening now. The EMA, exponential moving average, fixes this. It weights recent bars more heavily than older ones. Imagine the window as a staircase. Yesterday's bar matters most, the day before a little less, and so on, fading back. The effect: the EMA turns sooner than the SMA when price reverses. Use SMA when you want a stable long-term reference. The 200 SMA is classic for big-picture context. Use EMA when you want your line to react quickly. Swing and day traders favor it. Same data, different math. The EMA just cares more about what just happened. Now that matters because the key moving average every trader watches, the one ArcAlpha uses as mean, is an EMA. 3 moving averages dominate most charts: the 21, the 50, and the 200. The 21 EMA tracks the short-term trend, roughly the last month of price action. Why 21? It's a Fibonacci number, close to the number of trading days in a month, and it reacts fast enough for swing traders. On ArcAlpha, the daily 21 EMA is labeled mean. It's your anchor for how extended price has moved from its recent average. The 50-day average captures the intermediate trend, about 2 to 3 months of price memory. Institutions watch the 50 closely. Fund managers often buy pullbacks to the 50 in uptrends. The 200-day is the big one, long-term trend, almost a year of data. It's often called the bull-bear line: price above long-term bullish, price below long-term bearish. None of these periods are magic. They matter because everyone watches them, making them self-reinforcing. When all three align, 21 above 50, 50 above 200, that's a stacked uptrend. Price above all three EMAs in order. That's the cleanest trend signal on a chart. Flip them, 21 below 50 below 200, and you have a stacked downtrend. Here's where most beginners miss the point. They ask, is price above or below the MA? Important, but not the whole story. The real question: what's the MA doing? If it's sloping up, the trend is up. Pullbacks are buying opportunities. If it's flat, the market is ranging. Neither side is winning. Trend strategies stall here. If it's sloping down, the trend is down. Rallies are selling opportunities. Slope tells you the regime. Price position tells you where you are inside it. On one chart, you'll often see all three: an uptrend, a chop phase, then a breakdown. The MA's slope is what tells you which is which. One of the oldest rules in technical analysis: don't trade trend strategies when the MA is flat. Train your eye to read slope first, price position second. That's the shift from novice to experienced chart reader. Rising means up, falling means down, flat means wait. Remember support and resistance. In the last video, we drew them as horizontal lines. Moving averages are the same concept, but they move with price. In an uptrend, price pulls back toward the 21 or 50, finds buyers and bounces. In a downtrend, rallies run into the 21 or 50, get rejected and reverse. On the daily time frame, the 21 EMA is the most watched dynamic mean. When price stretches far from it, traders ask, how extended is this? When price pulls back to it, that's where defenders live. Moving averages also generate signals when they cross each other. When the 50 crosses above the 200, it's called a golden cross, a major long-term bullish shift. When the 50 crosses below the 200, the death cross, a major long-term bearish shift. Crossovers lag. They confirm a trend after it's already started, so they are direction signals, not entry signals. On shorter time frames, crossovers of the 21 and 50 give earlier, but noisier signals. Horizontal levels tell you where prior battles happened. Moving averages tell you where current momentum is anchored. Use both static levels plus dynamic levels. That's how experienced chartists see a market. Let's bring it together. A moving average smooths price into one number per bar, revealing trend direction. EMAs weight recent bars more, so they react faster than SMAs. 3 matter most: the 21, 50, and 200. Short, intermediate, long-term trend. Slope is the signal. Rising is up, flat is weight, falling is down. In trends, MAs act as moving support and resistance. Crossovers confirm bigger shifts. On ArcAlpha, every chart shows the daily 21 EMA as a line labeled mean. That's your anchor. Price extended from mean is price stretched from its average. Far above mean, potential for mean reversion down. Far below mean, potential for mean reversion up. Look at slope to know the regime. Look at distance from mean to know whether the move is fresh or stretched. This is educational content and is not a recommendation to buy or sell any security.